Whether it's Elon Musk, Dana White, Bill Gates, or Bernard Arnault, billionaires are literally drowning in debt. But for them, debt isn't a burden, it's a privilege. The ultra-wealthy don't live off their income, they live on credit. They use leverage to fund extravagant lifestyles while skillfully sidestepping taxes. It may sound like fraud, but it isn't. This is a fully legal mechanism, and in theory, it's something anyone could access. Today, that's exactly what we're going to explore. What in Europe is known as the Lombard loan, and in the US, more often called a margin loan. So buckle up, because what you're about to discover may well change the way you think about money. The term Lombard loan goes back to medieval Lombardy, one of the wealthiest regions of Italy. At that time, Lombard bankers had already established themselves as key players in European trade. Their principle was simple. They would only lend money if the borrower pledged collateral. A merchant could, for example, hand over jewelry or goods of equal value to the loan requested. If the debt wasn't repaid, the banker would simply sell the collateral and recover his money without loss. You see, the Lombard loan used by the ultra-rich is actually very simple. A loan secured by something of value. And yet, it is incredibly powerful. Today, it all depends on what you put up as collateral. If it's jewelry, watches, or gold, that's just a pawn loan. But if the collateral is your financial investments, a brokerage account, a retirement plan, an insurance policy filled with stocks and bonds, then it becomes a Lombard loan. And in private banking, some institutions start offering it from as little as $150,000. You might be asking yourself right now, is a Lombard loan something I could actually get? The way it works is very different from a regular mortgage. Your salary doesn't matter here. What matters is the collateral you can bring to the table. If your assets are considered rock solid, the bank will let you borrow more. And every bank sets its own rules through what they call an LTV, or loan-to-value ratio. In simple terms, that's the ratio between the credit you receive and the value of your collateral. Here's an indicative range of LTVs you'll typically find. But keep in mind, these numbers vary from one bank to another and depend heavily on the quality of your assets. Let's take an example. If you pledge US Treasury bonds, you're putting forward one of the safest assets in the world, AAA rated, with virtually no risk of a sudden drop in value. In that case, the bank might lend you up to 95% of their value. But if what you pledge is a portfolio of US equities, the picture changes. Stocks can swing violently, and the risk for the bank is much higher. That's why in this case, the loan-to-value will be kept much lower, around 70% at best, but usually closer to 60%. So how do you actually read this LTV in practice? Let's say your brokerage account filled with US equities is worth $10 million. If the bank applies a 70% loan-to-value, that instantly translates into a credit line of $7 million. Stocks are volatile. They can surge or collapse in a single day. Now imagine your portfolio is worth $10 million, and you've borrowed $7 million against it with a 70% loan-to-value. So what happens if the market suddenly turns? Banks don't gamble. They build in safety triggers, 2 levels of alerts designed to keep the loan covered at all times. The first alert is a warning shot. If your portfolio falls to $8.7 million, your ratio is no longer 70%. It jumps to 80%. At that point, the bank steps in. You have 2 options. Add more collateral, for example, another $1.2 million worth of stocks, or repay part of the loan. For instance, paying back $625,000 would reduce your loan to $6.4 million, bringing the ratio neatly back to 70%. It's the bank's way of saying, top up or pay down, but fix the balance. The second alert is where things get serious. If your portfolio keeps falling down to around $7.8 million, the ratio spikes to 90%. At this stage, the bank doesn't wait. Contractually, it has the right to liquidate part or even all of your stocks to recover its money. The result? The bank is safe, but you lose control of your portfolio overnight. And then there's the nightmare scenario, a sudden market crash. If your portfolio plunges so sharply that its value can't cover the loan, the bank will still come for the balance. You'd lose your entire $10 million portfolio, your Lombard loan would disappear, and on top of that, you'd need to inject fresh cash to repay whatever is still owed. It sounds extreme, and it is. Rare, but it has happened before, and it's exactly why banks almost never lose. But setting risks aside for a moment, what about the everyday reality of these loans? So, what's the downside of a Lombard loan? Even though the interest rates may look relatively low, it can actually cost more in total interest than a regular amortizing loan. Why? Because with an amortizing loan, you slowly repay the principal. Each year, the balance gets smaller, and so does the interest you pay. But with a Lombard loan, the full principal remains outstanding until the very end, which means you keep paying interest on the entire amount year after year. But here's the flip side. That same feature can be turned into a huge advantage. If your portfolio earns more than the cost of the loan, you capture the spread. Let's say you borrow at 2.5% and your investments return 8% per year. That's a 5.5% gain on money you didn't even have before. In other words, the longer you keep the capital invested, the more you can benefit from compounding returns while avoiding the need to sell your assets just to make repayments. And by not selling, you also avoid triggering capital gains taxes. A Lombard loan isn't free money. The price you pay is the interest rate, and it's built in two layers. The first is the market base rate. In the United States, that's the SOFR, the Secured Overnight Financing Rate, which tracks how much it costs banks to borrow cash overnight when pledging treasuries as collateral. As of late August 2025, SOFR sits around 4.3%, which is high by historical standards. In Europe, the reference is the 3-month Euribor, currently much lower, around 2.0%. On top of these base rates, your private bank adds a margin, usually 1 to 1.5 percentage points, depending on the risk of your collateral and your relationship with the bank. Right now, with market conditions as they are, the cost is about 5.3 to 5.8% in the US, but only 3 to 3.5% in Europe. Here's where it gets interesting. Most Lombard loans are structured as interest-only facilities. That means you don't gradually reduce the debt, you simply service the interest. The principal, often fixed for 5 years, stays untouched until the very end. And in private banking, some agreements don't even have a maturity date. As long as you keep paying the interest, the loan can stay open indefinitely. Let's take an example with a 5-year loan. Imagine you pledge a stock portfolio worth $10 million. With a 70% LTV, the bank grants you a Lombard loan of $7 million. If the rate is 5%, here's how it works. At the end of year 1, you don't repay any of the $7 million principal. You just pay the interest, $350,000. Year 2, same thing, another $350,000, and year 3 and 4. Still $350,000 each year. By the 5th year, you've paid the interest annually, but the full $7 million principal is still outstanding. At maturity, you repay that principal in a single payment. Now, let's compare with Europe. With benchmark rates lower, say around 3.2%, the same $7 million loan would cost only about $224,000 per year in interest, or $1.12 million over 5 years. That's almost half the cost of an equivalent facility in the US. That's the usual structure of a Lombard loan. Lighter cash flow every year, with the advantage of keeping your capital intact until the very end. And here's what makes Lombard loans so powerful. In private banking, some facilities don't even have a maturity date. As long as you keep paying the interest, the credit line remains open indefinitely. That means you can stay fully invested in the market while using the liquidity to acquire real estate and expand your property empire, or to finance a lifestyle that remains largely untaxed, since you're not selling assets and triggering capital gains. One of the greatest strengths of a Lombard loan is the freedom it gives you. A mortgage can only buy you real estate, but a Lombard loan? There are virtually no restrictions. You can use the credit to buy property, increase your exposure to the stock market, invest in private equity, or simply finance your lifestyle. Vacations, art, a new yacht, or even a Ferrari, since the bank doesn't dictate how the funds are used. That's why these loans are often described as unrestricted credit. They give you liquidity you can deploy however you want. Lombard loans are not something you'll find at your everyday retail bank. They're a private banking product designed for clients with substantial assets. Entry levels vary, but in most US private banks, you'll need at least a few $100,000 in eligible securities to qualify. For high net worth individuals, facilities can easily run into the tens of millions, and for billionaires. And here's the key. This is exactly how many of the world's biggest fortunes keep expanding. By pledging shares of their own companies as collateral, they unlock liquidity to buy more businesses, expand into new markets, or diversify their wealth, all while keeping control of their core holdings. Take Bernard Arnault, often the richest man on earth depending on the markets. He can go to BNP Paribas and pledge, for example, $30 billion worth of LVMH stock. At a 70% loan to value, that gives him instantly access to over $20 billion in liquidity without selling a single share. And what can he do with that? He can channel part of it into trophy real estate, apartments in Paris, villas on the French Riviera, or penthouses in New York, further expanding his real estate empire. Another slice can finance his lifestyle, yachts, his art collection, or even private jets. And the rest can be reinvested into businesses, new ventures, or acquisitions that expand the LVMH empire. All the while, without selling a single LVMH share. But it's not just for billionaires. Even investors with a few million, sometimes as little as $500,000 in a portfolio, can use Lombard loans to accelerate their wealth building. Think about acquiring real estate, launching new ventures, or scaling existing investments. And here's where things get really interesting. The golden rule is simple. Income pays the bills, but capital builds freedom. The fastest way to erode wealth is to consume your capital or draw too much taxable income. In the US or Europe, dividends are taxed, salaries are taxed, selling stocks or real estate, also taxed. But a loan? That's different. Debt is not income, it's a liability. And you can't be taxed on money you owe. That's why the wealthy love Lombard loans. They can unlock liquidity from their portfolios without triggering a taxable event. They can fund their lifestyle, expand into new investments, and preserve their capital base, all while minimizing taxes. By now, you can see why the wealthy love Lombard loans. If you hold a large stock portfolio or shares in a highly valued company, it often makes more sense to finance your next vacation, your car, or even your home through a Lombard facility rather than by selling assets. Yes, you'll pay interest, but even at 4 or 5%, that's still far less costly than a salary taxed at 40% or dividends taxed at 30%. Here's the strategy. Many wealthy individuals pay themselves only a minimal salary, just enough to cover required contributions and some interest costs on the loan. The rest of their lifestyle? It's financed entirely through the Lombard credit line. This is how billionaires end up paying proportionally far less in taxes than the average professional. They minimize taxable income and use debt to fund everything else. Let's make it concrete. Imagine you've built a portfolio worth $5 million. Over time, you put in $3 million and it has grown by $2 million in unrealized gains. Now, you want to buy a vacation home in Miami. The obvious move would be to sell part of your portfolio to free up the cash. But the moment you do that, you trigger capital gains tax on those $2 million, and a big part of your profit goes straight to the IRS. With a Lombard loan, it works very differently. You pledge the entire $5 million portfolio as collateral. At a 70% LTV, the bank instantly gives you access to $3.5 million in liquidity. That means you can go ahead and purchase the property without selling a single share, without triggering a taxable event, and your investments keep compounding in the background. Most people in that situation would sell some stocks. But the moment you do that, you trigger capital gains tax, and suddenly those gains feel more like a burden than a blessing. The wealthy do the opposite. They use their unrealized gains as collateral to negotiate a larger Lombard loan. The bigger the portfolio, the more credit capacity the bank will extend. So instead of selling and paying tax, you pledge the assets, take out a Lombard loan, and enjoy your wealth at a much lower fiscal cost. Meanwhile, your portfolio keeps compounding in the background. Now, let's flip the perspective and look at it from the bank's side. When a bank lends you money, it usually faces two big risks. You might not pay the interest, or you might not repay the principal. With a Lombard loan, both of those risks are covered. The collateral. Your portfolio can be liquidated if needed. So for the bank, this is one of the safest loans they can make. And that's why they love it. They earn steady interest on a highly secured loan, with very limited downside. In fact, Lombard loans are so profitable and low risk for banks that they'll often give clients extra perks, lower margins, better terms, or even more personalized services just to keep that relationship. Here's where it gets interesting for the client. Let's say you pledged a portfolio worth $2 million, and the bank extended a Lombard loan of $1.4 million at 70% LTV. 5 years later, your portfolio has grown to $4 million. At the same LTV, your borrowing capacity has now doubled to $2.8 million. So what happens? You simply take out a new Lombard loan, use part of it to repay the original $1.4 million, and still walk away with fresh liquidity on top. That's called rolling the debt, borrowing against the new, higher valuation of your assets to refinance the old loan and unlock even more cash. It's a cycle that can continue for decades, as long as your investments keep appreciating. And it's not just portfolios of listed stocks. Many wealthy clients use Lombard Credit together with holding companies to finance real estate investments. Here's how it works. Imagine your holding company collects $200,000 a year in dividends from your operating businesses. Instead of distributing that money and paying income tax personally, you leave it inside the holding. There, it's taxed only at the corporate level. Far more efficient. Now the holding takes out a Lombard loan, secured by its portfolio of assets. With the liquidity, it can fund a $3 million commercial property acquisition, plus renovations. Rental income from the building helps service the interest, while the holding keeps control of its investments. This structure allows wealth to grow inside the company, compounds faster, and avoids the tax friction of pulling money out into your personal name. You now master the basics of the Lombard loan. I hope you enjoyed the example. We'll be back soon with more videos. Until then, happy investing, and see you next time.